What's going on, you guys? Today we're going to be talking about how investors are coming back into Canada full swing. So the Globe and Mail just put out an article a little while back that stated that investors were coming back into Canada with a lot of interest in trying to buy assets. The assets that these guys are trying to look for is something that's called a multifamily asset. Most commercial investors usually look for something like that. Very rarely, if ever, will they ever buy something that's a single family property or just a single asset itself, unless it's something that's very significant, like an historical property or something that has a lot of political significance. Sometimes properties that are used by the Crown, they end up being bought by commercial investors, right? It doesn't really produce much income, but it's just there as something that they can add towards their portfolio. But a multifamily asset, that's what they're looking for, is any asset that has 2 or more dwellings within the same building, right? So this can be anything from like 2 to 300 units in one dwelling. Canada doesn't really see too much of that, Most of the times you end up seeing that property type in America. In America, you end up having a lot of multifamily properties. Those multifamily properties are mainly for rentals. Usually one investor owns them. The same investor usually has a portfolio of 3, 4, 5 units. These smaller level multifamilies, anything from 4 units to about 20, 30, are owned by usually a syndication of smaller investors. The larger commercial grade investors are owning properties that are a few hundred units. Just because you're putting the same amount of effort in terms of managing, buying, running the mortgage, having the whole team operate on an asset that's just as big as anything that's smaller. It takes the same amount of time, takes the same amount of effort, so why not make more money off of it? That's their logic going into it. Right? And when you have the economies of scale working for you in a larger asset, you can actually use that a lot better in terms of refinancing debt to pick up other assets, right? Or even restructuring the portfolio with that asset specifically, right? So if you wanted to create, if you want to add more additions to the unit, you can do that better. You can do it easier. You can't really do that if you have a few units. And if, let's say, 1 month you're doing pretty poorly on the cash flow, that property that had 3 or 4 or 2 units or even 6, 7 units, if 1 or 2 of those units are out, like they're vacant, then you're gonna have a hard cash flow for those 1 or 2 months. And that hard cash flow through that period affects you for the rest of the 12-month period. Whereas if you have a larger complex of 30, 40, 50 units, and you have 3, 4, or 5 units in that go vacant for a month, it doesn't really hurt that much, right? Just the economies of scale that work better for you there. So when you look at the market before the pandemic, what was happening in 2018, 2019 was that a lot of investors were just picking up assets at ridiculous cap rates. The reason that was happening was because a lot of investors were thinking of Canada as an insulated area, as an insulated region, right? So we had enough people coming in, we had a shortage of supply, which is going to take a very long time to develop, and we also had decently low interest rates on the debt. So investors were thinking, you know what, as a long-term play, we're not really looking at purchasing something for 1 to 2 to 3 years. We're looking at something, in the 5, 10, 15, 20-year term. So they said, you know what, why not purchase it? So they purchase these assets, sit on them, and just let the cash flow eventually get to the point where it needs to go. But what actually scared investors during the lockdown period, like why they wanted to sit on their cash rather than invest with it or play with it, is simply the fact that immigration stopped, right? Nobody was coming into the country, nobody's really leaving the country. A lot of transport and travel back and forth was gone. There was also a looming presence of having extremely high vacancy because no one was working, no one was saving money, everyone was just sitting around doing nothing, waiting for something to happen, right? That happened, coupled with the lack of immigration, coupled with the lack of overly priced assets, especially the newly built product, plus the fact that what was going to happen next was going to be a rent collection delay, right? So when you can't pay off your mortgage, you can't pay off for your rent, no one wants to pay rent, no one wants to move out. And in Canada, unlike the US, you can't really kick somebody out after 2 weeks if they don't pay rent, right? So all of that together really ended up causing sort of a crippling effect for any sort of institutional investor, because they couldn't see what was going to be happening the next 4 to 5 to 6 months. Whereas the market going to go down? Was it going to plateau? Was it going to increase? But what we've seen since then is that the residential transactions have actually increased. Not the number of them, but the value of them have actually increased. That's mainly because during the March, April, May, June period, not much was happening. So a lot of that pent-up demand was mainly put into people renovating their properties and trying to flip them later on in the course of the year, which is great. But a lot of that pent-up demand got pushed back, right? So now, instead of having a lot of transactions run in the spring and the fall time, they were pretty much running from the end of summer until now even. Right? Properties are coming out, they're gone in less than a week. So that's what was happening before the pandemic and what's happening right now. Now let's talk about cap rates. A cap rate, aka capitalization rate, is pretty much a way to measure how much money an investment is making. How it works, or how the math is done, is it's the NOI, net operating income, divided by the purchase price of the asset. That'll give you the cap rate. Usually in real estate, to give you a rough example, in Canada, the cap rates are ranging anywhere between 5 to about 8%, give or take where you go. In the US, they're actually much higher, depending on the type of asset you get, because there's a large diversity of different types of multifamilies there. Whereas here, you got a lot more single family properties. There, you can range anything from 4% all the way up to 18, 20%. But just keep in mind, the higher the cap rate, usually the worse the area, the worse the asset. So higher risk, higher reward, because you're buying it for so cheap. Now, I believe the most expensive property that was put out as an investment multifamily property in Canada was sold in Toronto in 2019 or 2018 for about $40 or $50 million. That was at a 2% cap rate. That means the amount of money you made before making your mortgage payments was only 2% of the purchase price. Now, I understand the larger the property, the more expensive it is, the less you're going to make. But the reason this purchase was made primarily was because the asset within Toronto, the area within Toronto, is sort of considered the Miami of the US or the Singapore of the world. The reason that's being said is because those cities, Miami, Singapore, are considered to be so popular. The tax rates are very attractive. The type of people that go there are bringing businesses, are bringing money into the city, that it's just considered a safe haven, almost like gold. That's why it ends up being so attractive. Even if you get an asset that isn't going to be making much cash, but it's there as like an A+ asset, that means that that property's there, it's secure. If the market goes up or down, if it fluctuates like crazy, it'll be stable, right? So this property, these type of assets are meant to be, for a long term, 20, 30, 40, 50 year hold, right? So whenever anything happens in 20, 30, 40, 50 years, it's guaranteed to appreciate enough that it will make money. That's the main reasoning behind that. So now we get to the point of, if immigration has stopped, if people are seeing less income come in, if people are afraid of vacancies, why are investors coming back in? Well, that sort of problem was solved by itself, because it was just a matter of time to wait to see what's going to happen. The main reason behind the investors' confidence coming back into it is simply because of stable rents and vacancies. When you look at any sort of investment property, you're trying to see three things. How am I going to add more value to it? What's the vacancy like? And what's my exit timeline? So when you end up looking at these sorts of properties and you're seeing, I've got these properties, the value hasn't gone down, right? They're still paying rent. Roughly about 97% the rent for Canadian rent, most REITs in Canada, was paid out, which is great, especially in the pandemic time. So you got 97% of rent due, which is paid. Your vacancy rate has gone anywhere from 2 to 5%, which isn't a huge difference, especially considering that a lot of people are without jobs, they don't have too much support, plus you've got cheap debt. When debt's coming in so low that the 10-year bond rate's coming in less than 1%, and some banks like HSBC are advertising a variable rate of less than 1% on your mortgages, why wouldn't you take that? That's almost guaranteed. That's guaranteed money, right? If your money is so cheap that's almost at 0% interest, always take it. Refinance it, take it. Just take into consideration that whatever you're breaking the contract fees are, they aren't going to be larger than whatever you're going to be saving from your new refinance rate. Plus, the investors have been doing nothing with their money for the past 5 to 6 months. And when that happens, you've got people that are antsy. Sometimes they're antsy. Usually these real estate investors are thinking, 5, 10-year terms per transaction that they make. So I highly doubt that they're too antsy, but if you're doing nothing with your money for about 5 to 6 months and it's just sitting there, you're just putting into bonds or you're putting into other securities to get some sort of return, then you end up looking back into your model to see, where can I put the money in now? And when the market is recovering now, plus the COVID vaccine is just around the corner, and it looks like job losses are going to be stabilizing, then it looks like it's a pretty good time to purchase stuff right now, especially if you have poorly managed assets, if you have distressed properties, if you have stuff like that, now is a great time to buy. Alright, so there you have it, guys. This is why investors are coming back into Canada. And I'm sure you're gonna have some questions. If you do have any questions, or if not, feel free to like, subscribe, whatever you want. And if you have any sort of requests on what type of videos you'd like to see next, feel free to leave a message. Thank you, take care.